Hello everyone. So today our aim is to uh, prove if W2 is a standard Brownian motion. So we have to prove that WT square minus T is a martingale, and we have to explain its financial implementation. So what is a martingale? A martingale is a stochastic process where expected future value given all current information equals the present value. So mathematically for a process xt, E xt plus S x mu x u less than t is equal to xt. In simpler terms, the best prediction for tomorrow's price is today's price. So that's the logical part. So we will derive the result using the formal definition of martingales and combined with the independent increments property of Brownian motion. The proof demonstrates why a deterministic term t create a fair gain from what otherwise would be a trending process. We then connect the theoretical results to the real-world applications in derivatives, pricing, and risk management. So let's start with the step one, which will be the mathematical framework and definitions. So before proving the martingale property, we establish our mathematical foundation. We work on a filtered probability space with natural filtration ft, which will be representing all information available up to the time t. The formal definition of martingale requires three base conditions. So let me mention the three conditions which are there. So it will be like xt for t greater than equal to 0 is a martingale with respect to ft if the three conditions are, first condition is xt is ft measurable. For all t greater than equal to 0, and the second condition is expectation of absolute value of xt is less than infinity for all t greater than equal to 0. And the third condition is expectation of xt given fs is equal to xs for all 0 less than s less than equal to t. So why we need these conditions? The third condition is the key martingale property. It states that the best prediction of future values given current information equals the current value. So this fair game property eliminates arbitrage opportunities under risk neutral measures, which is essential for derivative pricing. Now, for standard Brownian motion, we have the four defining properties. Let me mention them here. The four defining properties for the standard Brownian motion. So the property is W of 0 equals to 0 and WT follows a normal distribution with mean 0 and variance t. So it's written something like this: 0 and the variance t, and W of t minus W of s is independent of fs for t greater than s, and W of t minus W of s follows a normal distribution. It follows a normal distribution with mean 0 and variance t minus s for t greater than s. So what is the main portion is we are writing this math. What is the economic interpretation of this? So the independent increments property mathematically formalize the market efficiency. future price movements are independent of past information. So let's go to step 2. We will verify the Martingale prerequisites. So to prove Wt minus T is Martingale, we must verify the preliminary conditions, that is integrability and adaptiveness. So for integrability, let me write this. For integrability, since Wt follows a normal distribution with variance T, here we will return something like expectation of Wt square is equal to variance. It can be this normal variance of Wt in terms is equal to T, and the T must be less than infinity. And we can bound the absolute expectation of our processes. So the bounding will be done for this. So expectation of absolute value of Wt square minus T is less than equal to expectation of Wt square plus T, and expectation of absolute value of Wt square minus T is less than equal to 2T, which is less than equal to infinity. So why the integrity matters? So this condition ensures our variance process remains finite, which is essential for practical risk management. In financial terms, it guarantees that portfolio variance doesn't blow up to infinity. So for adaptiveness, Wt minus T is Ft measurable because it's deterministic function of Wt, which itself Wt measurable by definition of natural filtration. So the financial significance of this portion is adaptiveness means we only use information available up to time t when calculating the value at time t. This prevents looking into the future, a crucial requirement for a realistic trading strategy. So let's just jump to the step 3, which is the core Martingale proof setup. So now we need to prove the fundamental Martingale property. For any 0 less than s, which less than t, we must demonstrate this condition, which will be expectation of Wt square minus t given Fs is equal to Ws square minus s. And we separate the conditional expectation to isolate the stochastic component. So to do that, we will write something like this. So expectation W t square minus t Fs is equal to expectation Wt square for all Fs minus t. So we have separated this. So why this decomposition works? For deterministic term t can be pulled out of the conditional expectation, allowing us to focus on the stochastic component, which is Wt square. So the key insight of expressing Wt in terms of information known at time t plus the increment from s to t will be something like this if we demonstrate it. So Wt is equal to Ws plus Wt minus Ws. And now we'll be squaring both sides. So it will become, so I'll just do it here. So we'll square both sides. So Wt it becomes something like this. Wt square is equal to Ws square plus 2Ws WT and WT minus of WS plus square term WT WS square. So the economic intuition of this part is we decompose future variance into three components: the current variance WS square, correlation between current level and future increment, and the pure increment variance. So this decomposition is fundamental to understanding how portfolio variance evolves over the time. So let's jump to step 4, where we'll be applying the conditional expectation properties. So do something like this. So let's take in the conditional expectation of our extended expectation. So which we have done up. So if we take the expectation of this, it will be something like this. Expectation of WT square given Fs is equal to expectation of W square given Fs plus 2Ws expectation of WT minus Ws given Fs plus expectation of WT minus Ws square for all Fs. So we will evaluate. So we will evaluate each term separately. So since Ws is Fs measurable, it is known at the time S. So we can write expectation of W square given Fs is equal to W square. So information available at time t s includes the exact value of Ws. So the conditional expectation doesn't change it. So the simplification accordingly. For the second term, we will use the independent increment property. Since WTN minus WS is independent of Fs, so we will can write this expectation of WT minus W of S for given Fs is equal to expectation of WT minus WS is equal to 0. So the critical financial insight is the zero expectation means Brownian motion has no drift future price movements have have no drift, and future price movements have zero expected value under reasonable measures. So this mathematical property underlines the efficient market factor. So no ground motion is no different, like future price movements have zero expected value under the reasonable measure. So that's the main property that underlines the efficient market hypothesis. So for the third term, we need to solve. So independence allows us to remove the conditioning. So we can write it something like expectation of WT minus WS square given Fs is equal to expectation of WT minus WS square. And we can write it something like this. So further it can be written to variance of WT minus WS is equal to T minus S. T minus S. So the variance of future price movement depends only on the time interval, not on past history. So property enables variance swaps and volatility trading strategies. So let's jump to step 5, completing the Martingale proof. So we substitute our evaluated terms back into the conditional expectation. So this T minus S and the portion was become 0. It has the first first term has become ws squared. So it will be something like this. Expectation w squared given f equal to ws squared plus 2ws 0 t minus s, the expectation of w t squared given fs is equal to w s square is t minus s. So therefore our original Martingale expression becomes something like this. So expression of t square minus t given fs is equal to w s square plus t s minus t. So substitute to w s square minus s. So this establishes our Martingale property. So which is expectation of w t square minus t given fs is equal to w s square minus s. So let me just wrap it. The fundamental insight is the process wt square minus t satisfies the Martingale property. A termination term t exactly compensates for the natural upward drift that wt square would have, creating a fair game. So the financial interpretation is this Martingale represents the difference between realized variance and its expected accumulation. In derivative pricing, this property ensures that hedging strategies for variance-sensitive instruments are unbiased. What the unbiasing? So let's just connect to the stochastic calculus. So the results connect to deeper principles in stochastic calculus through its own lemma. For the function fx is equal to x squared. So the f w t equal to f first derivative w t dft plus half second derivative w t dt, and then dwt square is equal to 2wt dwt plus dt. So why its lemma applies? The additional dt term rises because wt has non-zero quadratic variation, unlike ordinary calculus where this term would be zero. So let's just integrate from 0 to t. After integrating, so we become something like wt square is equal to w0 square plus 0 to t integration of 2 ws dws plus t, and wt square is equal to 0 to t 2 ws dws because that's 0, so plus t. So since stochastic integrals against Brownian motion are Martingales, so wt square minus t is equal to 0 to t 2 ws dws. So the financial significance of this is this integral representation shows that wt square minus t is a stochastic integral, which explains why it's a Martingale. In hedging applications, this integral represents the cumulative P&L from a delta hedging strategy. So let's talk about the real world application and the model limitations, which is the main part use case. So the Martingale property has profound application in quantitative finance, but also important limitations. So the variance swaps. In variance swap contracts, traders exchange realized variance for a fixed strike. So the it's basically like the payoff is equal to realized variance minus K variance into the notional. So why this martingale matters? So fair pricing for variance swap depends on martingale property, ensuring a unbiased valuation under risk neutral measures. And the delta hedging applications are when hedging options the P&L from portfolio. Rebalancing follows martingale property similar to WT square minus T. This ensures that over many trades, hedging errors average is to zero. So let me just talk about the critical model limitations. So the mathematical framework assumes continuous trading, but the real market exhibit so some less the important transaction cost. So each portfolio rebalancing incurs bid-ask spreads and the commissions, which creating a systematic hedge errors. So and like discrete hedging, like portfolio adjustments happen at finite intervals, not at continuously. So leading to tracking errors. So and a jump risk, like stock prices can gap overnight or during market crisis like the 2008 financial crisis demonstrated how Brownian motion assumption fails during extreme events. And like during real world example, maybe which may I give you, like during the March 2020 COVID crash, many variance trading strategies suffered massive losses because realized volatility includes large price jumps not captured by the continuous WT square minus T framework. And the stochastic volatility part, the assumptions of constant volatility breaks down in practice. And volatility itself follows stochastic processes, creating additional risk factors beyond basic Brownian motion. And the market microstructure is something like in HF, high frequency trading. The continuous time assumption breaks down at millisecond time scales, where market microstructure noise dominates. So the conclusion which I can say is that so we have proven that WT square minus T is Martingale by leveraging the fundamental properties of Brownian motion, um, independent increments and non-known variance structures. The key Martingale insight is that deterministic term T exactly compensates for the natural drift in WT square, creating a fair game. So the main reason is creating a fair game. And this results provide the theoretical foundation for variance trading, delta hedging strategies, and derivative pricing. The Martingale property ensures that under risk neutral measures, there are no arbitrage opportunities in various sensitive instruments. While real market deviates from pure Brownian motion through jumps to transaction uh, cost, and stochastic volatility. These frameworks remain essential for understanding various behavior and constructing robust trading strategies. So the connection to quadratic variation and its lemma reveals a deeper mathematical structure that underlies modern quant finance and demonstrating how the stochastic volatility calculus transform complex financial phenomena into the traceable mathematical frameworks. So thanks for your time, and I will be also uploading the proof in the comments if you want to have a fast reference. So thanks for today.